The recession, the contraction in business, actually started in December of 2007. That's the date that business actually started to shrink, that personal income started to shrink, and that continued for 18 months, ending in July of 2009. As John said, most of us have not had experience with that kind of contraction before. If you look at the previous contractions, the one in 2000 and the one in 1990, those contractions lasted about 7 months, quite a bit shorter. Further, if you look at the depth of the contraction, business contraction was around 5% of GDP over this 18-month period. That's substantial. If you look at the previous two, going back 15, 20 years, 1 to 2% was the amount of GDP that went off. So we're looking at something that's a lot steeper. In fact, you have to go back to before World War II to find a contraction that lasted as long as the one we just went through. The one that came closest in 1981 was 16 months long. So when people call this the Great Contraction, it's not like the Great Depression, but it's certainly the largest contraction in business that we've had since that time. I do emphasize that it's not like the Great Depression. That was a whole different order of magnitude. Also picking up on what John said, if you look at, and I believe this all along, and there's a lot more research out now than 2 years ago when we first started talking about it, is this central role of real estate bubbles and price rising well before the business cycle turns down. And you see this in the case we're dealing with. It was in July of 2006 that the housing price, average housing price, quality adjusted housing prices peaked in the US. So that was a little more than a year before the actual turn down occurred. And they've been going down ever since. They've slowed down recently, but they've been going down ever since. From peak to where we are now, housing prices have gone down close to 30%. We have to put that in perspective in two ways. One is that from 1995 up until 2006, the quality adjusted price of housing and adjusted for inflation rose almost 100%. It took 100 years prior to 1995 for the quality adjusted price of housing to rise 100%. You had to go from 1995 back to 1895 and measure that period. So in 10 years, we get a run-up equal to 100 years prior to that time. That's an indication of the size of this bubble that was growing. The other thing is, nobody believes they're in a bubble when they're in it. Nobody does, or else they wouldn't be in it. You can't persuade people when they're in an asset price bubble that it's necessarily happening. There's a well-known book out now called 800 Years of Financial Folly. This time it's different. It's a study of why everyone claims that they're not in a bubble when they're in a bubble. And that's certainly true this time. Well, what do we know about housing price bubbles when they pop? The sad thing and the bad thing is the further up you go, the further down you go. And we went up a lot further than most of the big housing price bubbles that have occurred in the past. This 100% rise was truly breathtaking. Based on my calculations and looking at past declines in housing prices, we're at 30%. We could easily, by the time we bottom out, get down to 40% a decline in housing prices, which would put us back to housing prices as they were around 2003. That would be around 2003 when they crossed that mark. So it's not like we're going back to the 1950s. What John said was correct in an important way. Policymakers, Ben Bernanke, Larry Summers, others, our own Christina Romer, who's graduated from here, have never lived through what we lived through in an important way. The recessions that they grew up in and that I grew up in as an economist were all caused by a different phenomenon. And we spent our entire careers really learning how to control that, and that was inflation. We looked at all the recessions that began pretty much after World War II, all the way through the end of the 20th century. Almost all of them were associated with inflation getting out of hand, and then the brakes being put on, and we go into a recession. This is very common kind of, it was called stop-go monetary policy. Economists spent a lot of time trying to design institutions that would keep that from happening. And we pretty much did. We used things like inflation targeting. We shifted the way we thought about the weight between inflation and unemployment trade-offs, all of these things, so that was stopping these kinds of recessions from occurring. That's why we had so few recessions, really remarkably few recessions from 1980 to this time, unmatched in U.S. economic history, actually, because we pretty much had handled that. But with a new century came a new kind of turn down. And the interesting thing is, it's the kind of turn down that harks back to the early part of the 20th century. These are bubble-created or financial panics of one kind or another. If we look back, and John was referring to this, if we look back in the past, the recessions that look like this are ones like the Great Depression when it started with big housing price increases, a bubble popping. The Panic of '07, I know a few of you back there lived through that. And these are the kinds of recessions that we're getting into now, where there's an asset price bubble of some kind. Remember in 2000, 2001, it was the dot-com bubble that burst. That was a lighter one, it was a smaller one, but it was a precursor to this one. Housing prices are a lot more ubiquitous. The housing market's a lot bigger than the dot-com industry, so we got a lot bigger hit, even though the collapse in that industry was catastrophic for that industry. So the kinds of institutions we have going, and the monetary policy institution we had going, was working fine for last century. Well, how does a central bank behave in this century to deal with these kinds of bank panics and asset bubbles? Well, there's another tool that the policymaker, the monetary policymakers have, we kind of forgotten about. Typically when we think about monetary policy, you all know, well, the Fed sets interest rates. It lowers the interest rates to zero. I even teach that to my classes. And lowers interest rate to zero, it injects money in the system. But that's not the way central banks handled bank panics back in the day. Back in the day, they handled bank panics by being the lender of last resort. That means when nobody else was willing to take your paper or lend you money, they would step in and become the lender of last resort. That was the role when there was a financial panic of the central bank. We saw the failure of that during the Depression when the central bank did not do that. We saw the success of that in the Panic of '07 when private bankers came in and acted as lender of last resort. So we look at what the Federal Reserve does now, and it's incredibly different behavior in terms of the assets it buys and how it operates in monetary policy. It's really going back to acting as a lender of last resort. The very important thing that our central bank did during the height of the crisis was to step in and act as the lender of last resort in the so-called commercial paper market. The commercial paper market is a market where corporations borrow working capital. When that market shuts down, basically corporations can't get working capital, and companies like GE start having problems. If companies like GE start having problems, you know other companies are too. Nobody was buying commercial paper. The Federal Reserve steps in as the lender of last resort and starts that market up by acquiring about $1 trillion worth of commercial paper. Now, that sounds like a lot, but the commercial paper market is around a $2 trillion market. It's a big market, and starts that up again. You also see this, a little bit less of this, but some of this in the mortgage-backed securities market, where the Federal Reserve, strikingly different behavior, enters the actual private sector bond markets and starts acquiring private sector debt that nobody else will borrow, essentially taking toxic assets out of the private sector and placing clean assets in there. That's, again, acting as a lender of last resort. Now, that means, and I certainly believe this, that the Federal Reserve stopped the panic. It stopped the panic from getting worse. But it can't get what John was talking about. It can't get us over the hump in terms of recovery because damage has already been done. Real losses have occurred. There were 400,000 foreclosures that were put on hold just over the past 2 weeks. You can imagine how many homes are out there that are essentially valueless now. I am not a believer that fiscal policy is going to work to pull us out. I am a big believer that it's going to be organic, that we grow out of this sort of just by having a fairly moderate, low interest rate, low inflation environment. And as John said, it's hard to keep the U.S. economy from growing if it has a fairly stable financial system and a fairly stable price environment. The scary part is, it's pretty clear that the housing crisis and the mortgage-backed securities problem and all of that is not over yet. We see it, I think Larry was mentioning this earlier, we see these things coming up over and over again, and it could take 2 or 3 more years. That's about how long a real estate cycle has to work out. About 6 years. It takes about 6 or 7 years for it to work itself out. We're about 4.5 years into it, so we're not through with that. But that's where I think we are, and that's kind of like an overview of what's going on.